Now this was all about the property, plant and equipment. After property, plant and equipment, there are many other items in the balance sheet, which were governed by SOCPA standard. Some of them were not governed by any SOCPA standard, or IFRS is having separate financial instrument standard, as I told you before, that which is the most challenging and toughest standard. It would be, I cannot explain that standard within such a small webinar, but of course I can provide you the possible impact which financial instrument standards will have on the items of balance sheet. So these are the items, as you can see on the screen: trade receivable, investment in subsidiary, joint venture and associate, investment in equity, debt, financial instrument of other entities, cash and cash equivalent, loans, advances, deposit, some derivative transaction and hedge accounting, borrowings, other advances and convertible instruments. As you can see, this represents around 60% of the balance sheet. Now, this all will be governed by financial instrument standards, that is IAS 32, IFRS 9 and IAS 39. These three standards will govern the financial instrument accounting, or these three standards will govern all these listed items on the screen of the balance sheet. So you can understand how much impactful the financial instrument standard would be, and how much important it becomes to understand the financial instrument standard while going to the or while doing implementation of IFRS. If you will see any IFRS balance sheet of any company, you will find that majority of the items in the balance sheet are either financial assets or financial liability. So that is ultimately the financial instrument. Let us check what is the difference between financial asset and liability, and how financial instrument standard will have impact on such items. I would try to provide you the brief of how the SOCPA standard used to cover these aspects, and how IFRS will have impact of financial instrument standard, and what would be the potential challenges. So before going on to the standard part, or before starting the financial instrument standard or financial instrument standard impact on the balance sheet items, let us check that how these three standards provide something for the financial instrument. First of all, the financial instrument standard provides for the definition of the financial asset as well as financial liability. So financial asset is, definition of financial asset goes like this. A financial asset is a cash and equity instrument of another entity, a contractual right to receive cash or another financial asset from another entity, or to exchange financial asset or liability under potentially favorable condition. So this was the definition of financial asset. Now financial liability definition goes like this. A financial liability is a contractual obligation to deliver cash or another financial asset to another entity, to exchange financial asset or financial liability under potentially unfavorable condition. So as you can understand from the definition, it almost covers the majority of the parts of the balance sheet, like trade receivable are getting covered under financial asset, cash would be getting covered under financial asset, another loans or investments would be getting covered under financial asset definition, and would be ultimately governed by IAS 32, IFRS 9. So first the standard gives the definition part, and after definition part, whatever items of the balance sheet which would be governed by financial instrument standard provides initial recognition provision and subsequent recognition model for such items. For example, for financial asset or financial liability, financial instrument standard provides three options to value, or three options for classification. First option is FVT OCI, that is fair value through OCI. Second option is FVT PL, that is fair value through PNL. And third option is amortized cost. So ultimately, fair value through OCI means your fair value changes would be impacted in OCI, that would not ultimately affect your EPS. Fair value through P&L, that is FVTPL means fair value through profit or loss account. Your fair value changes of financial instruments will affect your profit or loss part and will not have an impact on will have impact on EPS but will not go to OCI. And third is amortized cost. So these three classification models are provided by IFRS for financial instruments. Now SOCPA was not having such detailed standard like financial instrument in Saudi Arabia. So now this is something altogether newly brought into the Saudi Arabia. So while implementation of IFRS in Saudi Arabian phase 2 companies, now these standards will play, this financial instrument part will play a major role. So first is the first point. Let's look at the first point now, which is separate standard covering investment in security with limited guidance. Now in previous gap, that is SOCPA, there was separate standard of investment in security, which was providing a very limited guidance on classification aspect and recognition aspect, measurement, disclosure aspect, etc. Now here IFRS has three different standards: IFRS 9, IAS 32 and IAS 39, which looks at the measurement, recognition, disclosure criteria and other parts of the other things of the financial instrument part. Now there was limited guidance on classification aspect, but here there are detailed guidance and classification is possible in three sections, as I told you earlier, that FVT OCI, FVT PL or amortized cost. Effect was there only on P&L as per SOCPA standard because there was no OCI under SOCPA standard. Now there is separate OCI under SOCPA standard where P&L is bifurcated between two parts, P&L and OCI. So of course the changes of fair value will either go to OCI or P&L based on the business model and SPPI test, which is there. And there was no guidance of expected credit loss. Now there is a guidance of expected credit loss model. Before going on to what is the expected credit loss model, or before discussion regarding how you will classify whether this financial asset will be classified as FVT OCI, will be classified as FVT PL or amortized cost, how you will identify this. So let me give you a brief example of financial asset. Financial asset is having three options of classification: FVT OCI, FVT PL and amortized cost. So how the equity investment, for example ABC LLC is having equity investment in some company, then this equity investment company will check whether it is held for trading or not. If this equity investment is held for trading, then IFRS 9 tells you to choose the FVT PL model, because since you are holding this investment for trading, then your investor should know through EPS change that when your gains and losses would be affected to the PL, will be transferred to the PNL through FVT PL classification, then EPS will be getting affected and your investors will come to know that you are holding this investment for trading purpose. So that should be reflected in your EPS changes. But when entity is holding the equity investment with a long-term strategic view, then a separate FVT OCI option is given to that company, whether company wants to follow that option or not. If company wants to follow FVT OCI option, then of course that fair value changes will go to the OCI part and it will not affect the EPS, because anyway investors are not interested in fair value gain or loss because company is holding the equity investment from the long-term perspective. So through this example of equity investment, I tried to explain you how, of course, there are separate provision for debt investment where company used to pass through the business model test, and business model of whether company is having business model to collect the contractual cash flow or to collect contractual cash flow and sell asset. Now through these two models, company will decide whether it will go for fair value option or amortized cost option. So there is a detailed guidance available under financial instrument standards where each and every financial asset and liability will have to pass through such business model test, and will then be decided that whether this will be classified as amortized cost, FVTPL or FVTOCL. Now, earlier we used to heard that impairment can be done of only property, plant and equipments. There was no separate guidelines for the impairment of financial assets, like impairment of investment in subsidiary, investment in joint venture, impairment of investment in equity instrument, impairment of trade receivable. Of course, this type of things were not there, but now since all these items will be covered under financial instrument part, so the impairment provision which are there under IFRS, which is governing financial instrument, will affect this part, and all these items will be all these financial assets will undergo impairment test. Now that impairment test is also provided under IFRS. How this impairment test will be considered? This impairment test is nothing but the expected credit loss model which will be followed under IFRS. Companies will have to prepare one expected credit loss model where company will decide that whether the credit quality of the financial asset like trade receivable, like investment, is deteriorated or not. If it is not deteriorated, then company will have to provide for 12-month expected credit loss. If it is deteriorated, then company will provide for the lifetime expected credit loss. There is a detailed guidance available, of course, on this expected credit loss model, but due to time constraint I cannot provide you the details regarding how you will prepare a expected credit loss model for your company. But of course there would be a major impact of this expected credit loss model on the company's financial assets, as well as the work of auditor will increase due to this provisions. So now if you will check my fourth item, you will understand that there was no guidance of expected credit loss of such asset, but now there is extensive guidance of expected credit loss model is available. Earlier equity and debt bifurcation or changes were not required. Now equity versus debt, that is, if there are convertible instruments like convertible debentures or convertible instruments are there, then this convertible instrument will be bifurcated between two parts, financial liability and equity, and based on the present value calculation using some discounting factor, market rate as a discounting factor, you will find out the liability portion and equity portion, and you will bifurcate this. This will of course provide you the correct picture of debt equity ratio. Now no accounting guidance of derivative contract was there in the SOCPA. IFRS provides detailed accounting guidance for such derivative contracts. Hedge accounting guidance was also limited under SOCPA, but now IFRS provide detailed hedge accounting guidance in the IFRS standards. So as I told you earlier that these standards are going to impact your 60% of the balance sheet. So these financial instrument standards, IFRS 9, IAS 32 and IAS 39, will be playing a major role while implementing IFRS in any second phase companies. Now potential changes would be limited expertise on valuation of complex instruments. As I told you, there is a fair value option, FVTOCI and FVTPL, available for classification. So if you select such option, then you will have to find out the fair value on each reporting date of such instrument. Now the valuation field will be facing many problems or challenges due to this provisions of IFRS. And its coverage to entire balance sheet makes this standard more important while implementing IFRS. Now changes or challenges which will need to be addressed while implementing IFRS in second phase companies would be fair value of such instruments, preparation of expected credit loss model as I told you, decision about business model test to decide the classification into FVTOCI, FVTPL and amortized cost, impairment of financial asset through that expected credit loss model, debt versus equity bifurcation, use of discounting factors and present value concept more frequently, hedge and derivative accounting, and all this ultimately auditors assessment will also play a major role. So ultimately This financial instrument standard will have a major impact while implementation of IFRS and will have to be studied in depth for implementation in any company. Now apart from this, there are other some items in the balance sheet like inventories, employee benefit provisions. How those items will be affected, let us check it. Inventories, earlier SOCPA standard was allowing LIFO method, weighted average method was recommended, but LIFO and FIFO were also allowed, subject to some disclosure of changes or impact as compared to weighted average method. And capitalization of borrowing cost on inventories which were taking larger time in getting ready was not there, but now there is a provision to capitalize the borrowing cost on such inventories which takes majority of the time to get ready. Earlier LIFO was prohibited, now earlier LIFO was allowed, now IFRS prohibits the LIFO because there are now only two options available as per IFRS, FIFO or weighted average. So companies which were following LIFO method in Saudi Arabia will have to change the method of accounting, or which will have to change the method of valuation of inventories, will undergo this change and will, as a potential challenge, you will have to analyze what impact it will carry on in valuation of inventories, what impact it will have on your current ratio, what impact it will have on your future profitability or profitability of year of adoption. This all will form a part of impact analysis thing while implementing IFRS in such company. Employee benefit. There was again a limited guidance available for the companies for employee benefit. Employee benefit is a part where whatever benefits are given to employee through end of service, while end of service or during the service are covered by this IFRS. So there was only limited guidance under SOCPA for employee benefits, and end of service benefits based on actual payment were used to be recognized by the companies in SOCPA. IS 19, which is there for employee benefit, provide detailed guidance, comprehensive guidance for employee benefit cost recognition. Now this IS 19 also have some relaxation for IFRS for SME. For SME companies, this of course carries some relaxation also. So like this, each and every IFRS standard carries some relaxation for SMEs. So while implementing IFRS for SME, of course you will have to check that relaxation also. So IS 19 requires you to bifurcate the employee benefits between two parts, that is as a defined benefit scheme or defined contribution scheme. So defined benefit scheme and defined contribution scheme bifurcation you should do, and then defined benefit scheme, in that case liability is accounted based on the actuarial valuation. So you'll have to value the actuarial, you'll have to value your defined benefit scheme plan liability as per actuarial valuation. Now this expertise of actuarial valuation is limited in Saudi Arabia, so that is again a potential challenge while following this IFRS or this IS 19. And discounting method will again be used here for long-term employee benefits. What are the other general changes? Like disclosure of extraordinary items was required under SOCPA. Now IFRS says that there is nothing extraordinary in the balance sheet. Everything is ordinary, so it prohibits the item to be recognized as extraordinary item. Again, as I told you, ISB keeps on keeps on review the current accounting system, and keeps on issuing the standards for detailed accounting treatment or changes as for meeting the current economic requirement of the world. So IFRS 16, IFRS 15, IFRS 16 leases, and IFRS 15, that is revenue from contract with customer, are recently issued by the ISB, and potential impact of such standard. Now of course the standards were earlier optional to adopt or voluntarily available for adoption, and ultimately now within some time IFRS it will become a compulsory for adoption. So of course, while implementation, it will be a key area to decide whether company wants to go for optional adoption or not. Now of course, IFRS 16 compulsory adoption goes from the 1st April 2018, and IFRS 15 optional adoption has also started. So this area will have to be checked in depth while checking the IFRS implementation in second phase companies. IFRS 16 leases was issued by ISB with a view that each and every lease contract should come in the company's balance sheet. A few operating leases were going off the balance sheet because of limited time of the operating lease, or because of small amounts that was going off the balance sheet. But now using the present value concept, IFRS 16 tells you to take that leases contract in the balance sheet and provide a present value of that leases in the balance sheet. So this type of changes keeps on going, ISB keeps on doing, and you have to be updated with those changes to provide proper financial reporting to your investors. Now, after finishing this IFRS impact on the balance sheet items, let us check how the IFRS will impact the major item of profit or loss account, that is revenue standard, that is revenue recognition. In profit or loss account, major part is revenue recognition. SOCPA was also having some standard for revenue recognition, which was emphasizing more on transfer of title of goods or on transfer of possession of goods for recognizing a revenue. But IFRS 15, which is recently issued by ISB, provides 5-step model for recognizing a revenue and provides detailed guidance for recognizing a revenue. Now, what are those 5-step model for recognition and measurement of revenue? Step 1 is that before recognizing any revenue, you first identify a contract with the customer. Then step 2 is identifying a performance obligation. Performance obligation is nothing but a promise made to the customer. That promise can be through brochures, or that can be found out in a contract, written contract. That can be a customary practice also of the business. So you have to identify performance obligations or promises in such contract. Then you have to determine a transaction price for such promises made to the customer or performance obligations. Then you will have to allocate a transaction price to each performance obligation. And then as and when the performance obligation gets satisfied, you have to allocate or recognize the revenue. Now this revenue standard itself takes a lot of time to explain because it is very much detailed, but I will try to provide you the brief of the standard along with the possible impact on the revenue or P&L. So along with example, I will try to explain you in brief how this standard will have an impact. So as I told you, in step 1 you will have to identify a contract with customer. That contract can be oral or written. Step 2, you are identifying a performance obligation or promises. Now if I want to give you an example, for example, a consumer durable company is selling a TV. Now along with TV, company is giving AMC services for 3 years. So now in this contract, company is providing 2 performance obligations. First is sale of TV and second is AMC contract for 3 years. So you will have to bifurcate this performance obligation. Now as a step 3, you will have to determine a transaction price. Now company, generally in consumer durable service industry, company has a common transaction price for both of these. Now while selling TV, they will not provide you transaction price separately for AMC and separately for sale of TV. They will be having a combo price. So as a step 4, you will have to allocate these 2 prices to each and every performance obligation, and as and when the performance obligation of sale of TV will satisfy, you will recognize revenue related to that performance obligation, and as and when the AMC part will satisfy over 3 years, you will recognize revenue related to the AMC part for 3 years. Now, as I told you that in many of the contracts, performance obligations would be separable, but transaction price cannot be separable. So that would become a challenge for the companies to identify this type of contracts, this type of different performance obligations, and then to identify different transaction price for such performance obligation. Now IFRS 15 also gives guidance on how to identify a transaction price for a performance obligation if it is not provided separately. Before that, let us look at how transaction price would be complicated to determine. Here IFRS 15 says that in case of variable consideration, you should use a probability distribution method to identify a probable amount which would be received, and that much revenue you should recognize based on that probability. There are two methods: expected value method, that is, if there are large number of samples, then you will provide a probability for each and every sample, and based on that you will determine the expected value of the variable consideration, and that you will use as a transaction price. If there are less amount of samples, then single most likely amount. Say there are 3 samples, then any one which is most likely to happen, that you will select as a transaction price or variable consideration. Significant financing element you will have to remove. For example, you are providing significant financing to your customer. You are providing more than 1 year as a payment option to your customer. Then of course there is a financing element involved in your consideration. So IFRS 15 requires you to bifurcate that finance portion from that consideration and show it as a finance income rather than an income from sale of goods. Now, as I told you, the allocation of transaction price to the performance obligation will be a key area, or will be difficult. So what are the 3 methods available for identifying a standalone selling price for each performance obligation? So as I given you the example that if company is selling a TV along with the AMC service, both are different performance obligation, but they are having a one contract price. So you will have to first identify a transaction price related to the AMC portion, and residuary value would be allocated to the sale of TV. So for finding out a transaction price for AMC, there are 3 methods. First is adjusted market assessment approach. This means that you will find out the market price of this AMC in the market if provided separately. You will allocate this to the transaction price of the AMC, and the residual amount you will provide to the sale of TV. So in second approach, that is expected cost plus margin approach, you are not able to find out the market price of the AMC. So you will go and find out the cost of providing this AMC service, and you will add a margin to this AMC cost, and that after adding a margin you will be able to find out a transaction price for the AMC part, and then with a residual approach you can find out the transaction price for sale of TV. Now this bifurcation of transaction price between performance obligation is important, because recognizing a revenue, entity will have to satisfy performance obligation. If performance obligation is satisfied, then only transaction price attached to that performance obligation will be booked. So performance obligation can be satisfied over time or point in time. If customer simultaneously receives and consumes all the benefit, if you are providing a professional consultancy service, in that case, as and when you are providing a consultancy service to the customer, he is consuming the benefit. So this is the type of overtime satisfying the performance obligation. Then if entities work create enhances asset controlled by the customer. For example, entity is providing some services related to the immovable property of the customer, then the entity's work creates immovable property for the customer, then this is the case of satisfying performance obligation over time. Entity's performance does not create asset with alternative use, and entity has an enforceable right to payment work completed till date. Now in this case also, this entity satisfies the performance obligation over the time. So as and when the performance obligation is getting satisfied, the transaction price attached to this contract will be recognized as a revenue. But if by this three method, if entity is not satisfying the performance obligation, then there is a point in time approach where there are some indicators like legal title transfer, possession transfer, customers acceptance. These areas, these indicators are of transfer of control. Once there is a transfer of control, then at that point in time you will recognize the revenue. For example, in our case, when we are selling a TV, is a separate performance obligation, and selling AMC is separate performance obligation, though we are taking one contract price for both of it. So while selling a TV, it is a point in time contract where control is transferred, where legal title is transferred. So it is a case of satisfying performance obligation point in time. So we will recognize immediately the revenue related to the performance obligation, that is sale of TV. But sale related to AMC is case of consumer simultaneously receives or consumes all the benefit while you provide the AMC service. So that is the over the time satisfaction of performance obligation. So here AMC part is satisfied over time and sale of TV part is satisfied point in time. So sale of TV will be recognized in the first year, revenue related to sale of TV will be recognized in the first year, but sale of AMC will be recognized over 3 years. Revenue related to sale of AMC will be recognized over 3 years based on the transaction price which we have decided, based on any of the three methods, that is market assessment approach, expected cost plus margin approach, or residual value approach. So at the end of the webinar, I would like to tell you that what are the important areas which would be having impact while implementation of IFRS in Saudi Arabia. First area is balance sheet, property, plant and equipment, and other financial asset or financial liability items. And then as a new revenue standard is ready with us. So while adopting or while implementation of IFRS, this revenue standard will have to be considered. A possible impact of this revenue standard on profitability of the company will have to be considered. So in this webinar, I have tried to provide you the major details, so which are there or which can affect the balance sheet as well as P&L. As it was only 1.5 hours to complete this webinar, I tried to provide you the maximum details from this webinar. But of course, you can stay in touch for your queries or questions, and you can write to jaydeep@apms.in or info@apms.in for your any IFRS related queries or IFRS related implementation queries in Saudi Arabia. You can anytime contact on this email ID. We will try to provide you the detailed guidance related to each query. Thank you.
दो घंटे से बोले जा रहा है।
तुम लोग सोचते रहोगे सारा कितना बोलेगा।